Hey guys, it's Yuki, your boy, and I'm back. And you're tuning into Invest Roundup. South Korea is now the in thing not just for K-pop fans now, but also for foreign investors who are now flocking into this Korean stock exchange or KRX. And over in US, things are not looking too bad either. In the last 2 weeks, the US stock market has soared to record highs as the market was flooded with IPOs and investors clamour to get a piece of everything. Well, let's find out more and get into this week's news. Disclaimer: whatever stock or news we talk about is not a recommendation to buy or to sell. These are just news we deem important, things we think you need to know if you're interested in the stock market or if you intend to invest. First news item: Airbnb makes a strong COVID-19 comeback. Airbnb had gone public on Nasdaq. Even though the COVID-19 pandemic has deterred most of us from traveling, it certainly didn't stop the vacation rental platform from bringing their company public. Pretty bold move if you ask me. Then again, this company is only one of the latest tech companies to go public this year. Experts have called it a record year for initial public offering as investors feed their FOMO and practically had a virtual rumble to snap up new offering. In fact, food delivery company DoorDash also made its stock market debut last week, a day before Airbnb, and their share price went up 86%. In its initial public offering, Airbnb raised $3.5 billion, which makes it this year's third largest IPO. Before the IPO, the company mentioned that they are expected to sell their shares between $56 and $60. The price, however, was later increased to $68, seeing as there was a boom among investors to get shares. And the market seems to agree that it's the right move because the company's share price more than doubled on the day of the IPO to near $100 billion valuation. That's twice the value of Marriott, the largest hotel operator. On the day of IPO, Airbnb started trading over $150 per share and closed at $144.70 on the same day. Earlier this year, the company had struggled due to the COVID-19 pandemic as traveling for leisure suddenly stopped. In April, even laid off almost 2,000 employees, and according to their balance sheet released in September this year, their total liabilities has been at its highest in the last 3 years. Fortunately, later this year, bookings have gradually bounced back as people travel to other cities for short getaways. Airbnb has upended the travel market with their revolutionary concept when it started, although they did cause some controversy, like in New Orleans when the local communities claimed that the company has caused their rental to skyrocket and making less houses available to them. But this doesn't seem to cause less enthusiasm among investors, especially with IPO frenzy at the moment. Another possible reason why this company had gotten such a great reception at the stock market is also the prospect of recovery in the travel and leisure industry in 2021. The stock closed slightly lower on Friday at $139.25. Second news item: South Korea takes the spotlight. It's suddenly all eyes on South Korea, and this time, it's not because of K-pop or their award-winning movies. The Korean Stock Exchange or KRX has been making headlines recently as foreign investors flock to get into their stocks. In fact, there was even a fund manager in Barring, Hong Kong who outperformed 97% of his peers just by investing in South Korea's tech stock. According to him, strong earning growth, attractive valuation, and a positive trend of cheap prices has been boosting the country's equities. And their tech stocks, including memory firms, have been experiencing structural growth, which makes the company more valuable, and in some cases, way undervalued compared to their share price. He even added that South Korea tech stocks still have plenty of growth opportunities, even though the country's market benchmark, the Kospi Index, has surged more than 90% since the initial impact of the pandemic in March. This is due to an increasingly strong investor appetite for shares in semiconductors company. The Korean exchange has been one of the world's best performing this year, attracting global funds of around $5 billion in South Korea shares since the start of November. Purchases of the country's blue chips is also hitting the fastest pace in 4 years as shipments of the semiconductors and mobile devices soared 52% and 60% respectively. Tech companies like Samsung and LG have benefited from the strong demand of mobile devices, TV, and other home appliances as people spend more time at home during the pandemic. Analysts have also expressed optimism on the outlook of South Korea's economy and markets next year. JP Morgan Chase forecasts that the Kospi will rise by another 15% in 2021 and that South Korea companies would post an average of 56% increase in their 2021 operating profits. By the way, before we go on to the next news item, click on the subscribe button below now so you will be informed the next time we upload a new episode. That way you won't miss any important market news. Last news item: Nasdaq removed Chinese stocks from indexes. The trade war between China and US continues, and this time the US is taking it to the stock market. Last week, Nasdaq announced that it will remove 4 Chinese construction and manufacturing companies from its indexes on December 21st, apparently in response to an order by the White House last month. This order barred US investors from buying security of blacklisted firms starting in November 2021, as the Trump administration claims that these companies were linked to China's military. These 4 companies include China's Communication Construction Corp., China Railway Construction Corp., CRRC Corp., and Semiconductor Manufacturing International Corp. China's foreign ministry was later reported to clap back against that move, saying that the US should stop abusing national power and national security concepts to suppress foreign companies. Even more unfortunately, it doesn't stop there. Index FTSE Russell had announced earlier that it would delete shares of 8 Chinese companies in light of move by the White House. And S&P Dow Jones Indices said on December 10 it would remove mainland-listed A shares, Hong Kong-listed H shares, and American depository receipts of 10 companies of all equities indexes before 21st December. And this is just a small chunk from the tip of the iceberg. For the last 2 years, US and China has been going back and forth in the public game of tit for tat. There was a Huawei ban from the US, the trade war tariff, the blame game in search of the source of COVID-19, the TikTok ban from the US, and not only that, US move to take down China were also recently joined by countries like India and Australia. For India, it was due to the death of at least 20 Indian soldiers in the violence face-off with the Chinese troops in June. In its latest move to keep China away from its country, India has banned more than 200 of mostly Chinese apps. And as for Australia, a boycott was called 2 weeks ago by Senator Pauline Hanson when China imposed import duties for their wines. In fact, she was also recently quoted to call for a ban on all Chinese investment in Australia until Beijing stopped blocking exports and remove huge tariff on wine and barley. Senator Hanson also urged the government to review their free trade agreement. Now the question is, considering all these bans and blacklists stem from the Trump administration, will things change when Joe Biden takes the office in January? And those are the 3 important investment news we had to share with you this week. Once again, we encourage you to get more information if you would like to act on any of the companies we have chatted about earlier. Comment below and tell us what you would like to see on Invest Roundup, and share this video with your friends, especially those who are vested in the stock market. See you again soon.